Hi, my name is George Dagnino. I'm the editor of the Peter Deck Portfolio Strategy and Management. Before I start, I would really appreciate if you could subscribe to my channel. That would really help. Thank you. Anyway, what I want to talk to you about in this video is the existing liquidity in the banking system, which is moving not only, is moving especially the stock market. On the other hand, has an effect also on business and the markets. I also would like to review trends in inflation and why probably we may have to deal with deflation. And then all this to wrap it up, how will commodities, uh, interest rates and bond yields, gold, um, the stock market will react to that. Oh yeah, and then I will also I found an interesting relationship with Bitcoin that I think I just it blew my mind when I saw it. Anyway, here we go. There are two systems basically. The way money flows is between the Fed and the banking system. The Fed can bring all the money they want to the banking system, but if the banking see problems, as I will show you in the economy, they are not going to lend. So what happens? The liquidity remains in, which is called monetary base, remains within between the Fed and the banking system. And I will show you the impact that that has on stocks. Of course, the way M2 goes, that is the flow of liquidity between the banking system and the economy, also has an impact on the economy. And this is the money basically that is printed by the banking system. Of course, the banking system print the money if they see opportunity. This graph shows two lines. One is the blue line is the change in of the stock market over 12 months, and the red line is the liquidity, the monetary base that I told you flows between the central bank, the Fed, and the banking system. This is the liquidity that is within the banking system, and this is how it impacts the stock market. So as long as this liquidity is improving, which is also called high-powered money, it increases. The chances are that the stock market is will keep on going up. The issue, of course, is it's true that the banks and the Fed, they have a lot of money circulating between themselves. But the issue is, how do the banks are willing to lend that money? And this chart shows that really banks do not wish to lend money because they see problems in the economy. And this is the one line shows the bank credit at all commercial banks and is the blue line. And then the red line is instead commercial and industrial loans. And as you can see, it's true that in the banking system there is a lot of money, but the banks are not lending. In other words, they are not printing the money, because that's really what happens, to give to business, to consumers to do their things. So banks see something that really is worrying them. And for that reason, by the way, not only they are not lending money, but they are raising lending standards as shown by some surveys of the Federal Reserve. Again, so we saw that there is liquidity here, and this liquidity is highly correlated with the trend of the stock market. However, business sees problems and they are not lending money. So this form of money is called M2. This is what the banking system prints money when they lend money to consumers and business. Now let's see what M2 now is telling us. MB is telling us is good news for stocks, but let's see now what the trend of M2 is telling us. This chart shows the graph of M2, that is the money that really is being printed by the banks. Now it shows a lot of wiggle, but there are some very clear patterns here. There is, if the long-term growth is around between 0 and 6%. This is the kind of growth needed to produce growth in the economy by about 6%. When the growth of M2 goes much above, higher than 6%, like in the 70s or now, we went up to 25, 20, 30%, then we got problems. and the problems are inflation. However, when every time the money supply M2 is contracting, so there is less money in the system in business for consumers to use, then we got problems. And usually, not only is associated as, no, let me go back one step, as inflation was associated with fast rising money supply above 6%, 7%, the contraction in the money supply strongly suggests that we're going to have much, much lower inflation. And by the way, right now, as of this recording, bond yields are dropping and bond prices are soaring. So that must be, say, something in the making there. Okay, so the money supply M2 is contracting because the banking system that doesn't seem to be excited about what they see in business activity. Well, the slower growth in business activity is probably the cause why commodity prices and short-term interest rates, the two-year treasury yields and commodity prices, the CRB, are now going down. Both commodities are coming down and interest rates are coming down. Of course, at this point, there is the famous question is, okay, some people believe the Federal Reserve controls interest rates. Well, if they control interest rates, do they also control commodity prices? Which I don't think anyone believes that. But my point is, with a little bit of sarcasm, by the way, is that this declines caused by market forces. It's not the Fed that raises or lowers interest rates. I know this is not a popular view, but that's what I believe. In my forecast, I don't never talk about what the Fed is doing or not doing. I really don't care. I look at business conditions, banking conditions, business is slowing down, money supply is contracting, businesses slow down. And what you see when a business slows down, you see two main things. Commodity prices decline and short-term interest rates decline. Of course, when you see the economy is slowing down, you see prices slowing down. And as I said in the previous slide, commodities declining, the red line. But also treasury bond yields, long-term treasury yields are also declining. Why? Because the economy slows down, inflation declines because of the contraction of the money supply, and therefore yields decline and bond prices go up. And this is exactly what is going on right now as of this recording. It's true that the economy is slowing down. Now, if it wasn't for the government, really the economy would be in deep, deep trouble. And the main reason, of course, is government spending and the infrastructure spending. You know better than I do, and there is not one road in our town that is not upside down. Anyway, and this is what's happening. This is the construction spending, which keeps the economy alive and growing at around 1.5 to 2% right now. But again, despite of all that, the prices and inflation are coming down. So there is a broad signs of weakness in the economy. And of course, all these trillions of dollars that the government is spending has to go somewhere, and this is where it goes. This chart shows the personal income and also consumer expenditures after inflation. And you can see that here the growth rate is around 1.5%, which is, by the way, is a long-term growth of the economy after inflation at this point in time. So yes, there is income. Yes, there is spending. It's very slow, and it's mostly caused by the aggressive spending of the government. But again, where are the consumers spending? Where are they putting their money? And this chart is very interesting because it shows personal consumption expenditures and durable goods orders. And the personal consumption expenditures is the red line. And as you can see, both of them, with the big ticket items, are not being ordered by business, which tells you capacity expansion is slowing down. and also consumers with the red line, they are spending for necessities. Yes, they're spending, as I showed you in the previous chart, but they're not buying the big ticket items. Big ticket items are refrigerators, there are cars, there are items that use furniture, things that you just spend a lot of money. So yes, income is growing, consumers are spending, but they're not too excited. I don't want to bore you with showing all sorts of surveys about consumers' optimism, which really they are as low as they can be. Everybody is saying, of course, the economy is strong. People are spending because employment is growing and the unemployment rate is low. But, however, there are some cracks in the unemployment figures if you look very, very carefully. This chart shows all employees for temporary help and then employment in the truck transportations. These are two interesting graphs, as you can see. Why? Because this line, and this line are recessions. And as you can see, this both temporary help services and truck employment, the change becomes negative. That is, they decline ahead of every recession. Look what happens here. So what that tells you that as you follow my tweets and what I write, the trucking business I follow because it's so important. If the trucks don't ship things, if people don't ship goods, the economy is not on a healthy pace. So trucking is important, and the temporary services is also important because when you want to cut cost, you always try to cut first the temporary service, and then you hold on the permanent one. So these trends are telling you something is wrong out there, which is what the banks have been saying if you follow their trends in lending and in the money supply M2. So the economy is slowing down. We saw that has an impact on commodities, has an impact on interest rates. What about inflation? Well, this is consumer price index. The decline is here. And if you look at the consumer prices for consumer durable goods, that is the goods where people are not buying, they're already declining. So there is deflation in the system. So it's true that because people are buying necessities, but when they buy big ticket items, they're not buying it. And therefore, the incentive is to lower prices to encourage consumers to buy. So the point is, the banks have seen problems. The banks are not lending. The money supply is contracting. Employment, there are some cracks suggesting that the economy is slowing down, and this is now having an impact also on inflation. These are the main trends that I've been talking about. So let's see what happens next. Okay, so we saw some assets classes are reacting to the slowdown in the economy. Now let's see other more specific ones like the price of gold. The price of gold is strong when things are dicey. And I've been following the 2000 level for gold here for a long time. And the importance of this level is now for the last almost 3 years, that every time gold bounces at 2000 goes down, bounces up to 2000 goes down. Now, when a price hits like that and still hangs around this resistance level, when eventually breaks this level, is going to be a nice move on the upside. Well, as of this recording, gold is now above 2000. Gold appreciates when this is not investment advice, this is just statistical stuff, but gold appreciates, gains in value when the economy slows down and the kind of trends that I discussed in previous slides are evident. As the banks are cautious because they see problems, they see the economy slowing down, And when the economy slows down, my basic rule is that prices of commodities like crude oil, copper, or the price of money, which is interest rates, decline. And the crude oil peaked in 2021, 22, and has been down ever since. There's been some little rally here, but now is going down again to the $70 level. So crude oil is down, supporting the idea that inflation will keep on going down. I love this chart because it shows how liquidity, again, the liquidity that is in between the Fed and the banks, the high-powered money, the way they call it, is it just proves my point. That's what drives prices. And the above chart is the Bitcoin. The one below is the S&P 500. Now, all the major turning points, Bitcoin and the stock market, tops and bottoms, happen exactly at the same time. Now, why? Because they're all both driven not by belief that Bitcoin is the savior of the banking system. It's just that when there is a ton of money around, people just buy anything they can put their hands on. And Bitcoin and the S&P 500 are the favorite of these people. So be careful when Bitcoin, they sell you the great idea that is a new thing on earth, but it looks like it goes up when the liquidity rises and goes down when liquidity is declining. So be careful. It's not in fact a coincidence that the market is at the same level as 2021, and guess where Bitcoin is? It's below the levels of 2021. So even the relative relationship of prices is the same. So again, be careful. It's not investment advice. It's just interesting relationships. Well, the market had a big move since October. What's going to happen next? Well, what happens next is this is the percentage of stocks above the 50-week day moving average, and this is, of course, is the S&P 500, and this one is the S&P 500, and this is the percentage of stocks above the 50-day moving averages. As you can see, all the peaks in the indicator below coincide with a peak in the stock market. Right now, this is here. You can think whatever you want to think. There is momentum and so on. There is liquidity, but this indicator suggests that maybe it's time to be careful. I wonder if now, again, as of this writing, the bond market is very strong. I wonder if there is a shift from stocks to bonds just as a defensive position. I don't know. That might be the case. Okay, I'm going to show you the theory, then I'll show you the practice so you get a better sense of what is the relationship between interest rates and stock prices. So bear with me. Here is what is this two lines. One, this is interest rates, and this is the stock market. By the way, this peak and this peak, they're slanted so I can explain it better, but most of the time they're very close together. The other ones, I'll tell you more later. Okay, so when interest rates rise, not right away the market peaks, but it takes a while until business really hurts and earnings start having a cost, as you say, interest rates rise, costs rise, inflation rise, and this business says, okay, earnings are gonna hurt. And this is when the stock market understands that and peaks. And the stock market is predicting increase in earnings. And of course, when will that happen? When interest rates and other costs decline long enough until profits at some point. Remember, this is not interest rates, it's crude oil, it's all cost, inflation. And then at this point, business makes money again. And this is when the stock market understands that and goes up again. Then the next cycle, business expansion starts all over again. Eventually, the economy is weak, then it strengthens, then interest rates are rising, and then the cycle starts all over again. One of the things that are useful from a statistical viewpoint, from here to here is roughly 21 months, roughly, plus minus. So when interest rates, let's say, have peaked in November, then tack 20 months and you will see the bottom in the stock market. That's really what it's saying. And then after the stock market rises, usually 1 to 2 years after that, the interest rates rise, and then the rise in interest rates signal that the economy has reached a mature level. Now let's see now how these two graphs look in real life. Okay, I'm going to select to explain the previous charts as it applies to the trends in between interest rates, which is the blue line, and the stock market, which is the red line. And as you can see, interest rates rise, but the market doesn't peak right away. It takes a while. Then after interest rates rise above a certain level, the stock market peaks. Then interest rates decline because now the economy is slowing down. Remember, when interest rates go too high, business slows down, earnings, and so on. So at this point, interest rates have peaked. But you see, the peak in interest rates is not followed by a bottom in the bear market. Between this point here and this point here, there's roughly, as I said, 20 months plus minus. It's the same thing as you can see from this peak in interest rates and this peak in interest rates. It takes a long time. So even if interest rates have peaked now, the stock market will bottom roughly a year and a half to 2 years after that. I know it's an unpleasant message, but that's what this chart is talking about. As I mentioned before, I published the Peter Dack Portfolio Strategy Management. You can have a free subscription, no credit card needed, if you go to www.peterdack.com. I wrote this book, which is was commissioned by McGraw-Hill Educations. After they saw my work, they said, "Why don't you write a book for us?" The reviews, quite frankly, I'm not to sound too cocky, but they're really impressive. I was so pleased by the reviews. Anyway, this is the book that's been translated in Asia. In case you are in Asia, you can read it in your own language. I also wrote 2 more books, and then I have my YouTube channel. Again, if you subscribe, that will really be appreciated. Thank you very much, actually. Well, thank you very much for reviewing this video, and if you are a subscriber to my channel, which is free, by the way, you will be advised right away if when I publish a new one. Again, thank you very much for following me. I really do appreciate it. Have a wonderful day. Take care.